We're going to talk some crude oil. One of the smallest changes on the day, but still a pretty good week behind it. And we've talked a lot about the commodities. So let's get into the equities and the investing side for stock managers like Rob Thummel, Senior Portfolio Manager at Tortoise. Rob, welcome to Schwab Network. Thanks for being here with us this afternoon.
Thanks for having me.
Absolutely. Crude oil, as we've talked about, seems pretty well ensconced in this like mid-70s range. Is that good for the drillers and the producers? Are feeling comfortable that it can hold on here?
Yeah, I think it's a good spot for everybody, right? It's kind of a Goldilocks scenario from a price perspective.
Exactly.
Drillers, the oil and gas, they can still do fine. They can still generate some cash flow, or earn good returns on equity for their shareholders, return that cash back to the shareholders in the form of stock buybacks and dividends. But more importantly, and just as importantly, it's good for the consumer, right? You talked about lower inflation. That's really important, right? And lower commodity prices, led by lower oil prices, can really help support lower inflation going forward. So this $70, $75 range, plus or minus $5, is a really good spot to be in, I think, for the domestic and global economy.
Now, thinking about where you want to be kind of in that stream of energy, everybody's been surprised, and I think one of the biggest stories of the year is how much the U.S. drillers have put out. Is that the trade, though, or has that been kind of like well understood? We've seen a lot of consolidation. How do you view that from an equity perspective?
Yeah, no, if you look at the stocks, and that's a good point. I mean, we are at record levels of production for crude oil in the U.S. Record levels of natural gas production in the U.S. and those records will probably be broken again next year. But if you look at where the stocks and where the performance has been in the stocks, it's actually been outside of the oil and gas producers and the oil and gas producing sector. You think about the majors, Exxon, Chevron, they're down for the year. But where you've seen this energy sector perform well is the infrastructure, energy infrastructure. Energy infrastructure stocks have performed, around 20 or up 20% or so, plus or minus a few percent, kind of in line with the S&P 500 and have kept pace. Those stocks have outperformed because they provide investors with really critical current income and growth in that current income. And I think all investors are looking for equities that can provide current income plus growth. And that's even more important as we move into 2024 because you're probably going to have lower yields from fixed income and money market accounts as the 10-year rate comes down. Well, if you're looking at energy infrastructure, you're probably going to have higher dividend income because that current income you're getting is actually going to grow in 2024.
So a good bit of this still is about income, about yield, about that kind of safety net that energy producers provide. So I guess then you're not going too far down like the quality spectrum. You're not interested in buying like hyper levered volume plays.
No, well, not right now. And honestly, in oil and gas and in the energy sector in general, it's kind of hard to find hyper levered names because the sector learned its lesson, right? And so in the last decade, you could have found a lot of those. But since 2020, the sector's generated a lot of free cash flow. Early in the 2020s, 2020, 2021, a lot of that free cash flow was used to reduce debt, get debt levels to more manageable levels. And so as you look at the sector today, it's much less levered across the entire energy sector. But there's still a lot of free cash flow that can be distributed to shareholders.
Okay. What about companies that have gone through consolidation or mergers? How do you think that affects the sector? Do you try and have that in mind after a couple of big deals that, okay, well, it'd also be a nice little bonus if I'm in a stock that might get acquired?
Yeah, well, at Tortoise, the way we look at it is we just look for the companies that have the highest quality assets in the highest quality areas and then really high quality management teams. So not necessarily playing any stocks for them to be acquired. Obviously, there has been a lot of consolidation in the oil and gas producer space. And so 2024, you're going to see a lot of those transactions go through the regulatory process and close. But ultimately, the energy sector, I think, is a better play on really fundamentals, essential assets. We all need energy. If the populations are going to grow and you're going to grow your economies globally, you're going to need more energy. I think it's been proven that oil and gas are really, really critical. Natural gas in particular is going to be needed for a long, long time. And so as we look at our investments, we just look at where is the demand for energy going to be and where's that supply going to come from.
The moves in Cheniere and Williams in particular with the connections to natty gas, despite that commodity price really falling apart this past year, is one to me that's the most interesting. So you're not concerned that that gap has to close at all? This is just purely about their financial stability, not a beta to the commodity price?
Yeah, no, that's a very good observation. So Williams and Cheniere are energy infrastructure named, and this gives a really good example of what really differentiates energy infrastructure from oil and gas producers. You're right. A producer, their cash flows would be tied to the natural gas price, which is down a lot this year, right? Energy infrastructure, it's not. Their cash flows are not down a lot this year. They're actually up. Williams has experienced higher cash flows than last year. Cheniere has had continued to have very strong cash flows, and that's because the businesses that these energy infrastructure companies are in are transportation related. They charge a fee in Williams's case to move product, natural gas, through pipelines. So more volumes, higher production. That means more cash flow for Williams. In the case of Cheniere, they're an exporter. They're the biggest exporter of liquefied natural gas to countries around the world, at least that leaves the U.S. And so that's been a really significant and an important trade over the last several years, as we know, as Europe has looked to replace Russian gas volumes, and a lot of that's come from the U.S. And Cheniere has been front and center in providing a lot of those and exporting a lot of those volumes from the U.S. to Europe.
Okay, love that description. It also makes me kind of think of, as we're kind of at the end of the year thinking about what people got right and what they got wrong. The longer time horizon tells us a lot of people were wrong about how they thought energy production in America was going to change under a Biden administration. What do you think has been most surprising, kind of just coming from the infrastructure perspective, not interested in like the political stuff, but just what did people get wrong and how much is coming out versus expectations?
I think right now investors didn't expect the capital discipline that a lot of the energy sector management teams have displayed to really take hold and stay in place. And so why is that
That's still a bigger factor.
It is. Well, it is. It's really important. I mean, it's become really important. I mean, some of the reasons why the energy sector has performed well is because companies have become more disciplined. They've generated more free cash flow, and as a result of that, they've rewarded investors accordingly. Now, the sector is still cheaper than the broader sector in a lot of measures, and free cash flow the sector is significantly cheaper from a free cash flow perspective, at least from a free cash flow yield perspective relative to other sectors. But that's been the biggest surprise is that, the sector for the last several years, and we think at Tortoise going forward over the next several years and decades will remain disciplined. And if the companies remain disciplined, investors are going to continue to want to have an allocation to the energy sector because that's where you're going to get significant dividend income, growth in that dividend, and stock buyback. So you're going to get a significant amount of cash coming back to you as the investor.
Okay. Rob, love the conversation. Very helpful for us and really important reminder of the quality of the characteristics of these companies, right? The underlying financial fundamentals seem like a huge part of this. And great timing, too, with the past kind of week here with crude oil. Appreciate it. Rob Thummel joining us from Tortoise.